Welcome back to Bold Dominion, a state news explainer podcast for a changing Virginia. I'm Mary Garner McGee. Well, we just couldn't get enough of tax season, so we're back again this week to talk in more detail about our Virginia state income tax returns. It's one of those things, we all do it every year, you just answer the questions, but if you've ever wondered what some of those questions mean, that's what we're here to talk about today. So I'm joined by our tax crew from the last episode, Ben Larson.
Hi.
Sage Tangway.
Hello.
And we have our assistant producer, Sarah Bastinelli, in the studio.
Hello.
Okay, how's everybody feeling?
I'm feeling great. I think I have a really simple return. My husband just finally sent me the last document I needed. He said his hands are covered in grease because he's like cleaning tools at work. But he sent me the PDF. So.
It's a good thing we don't file on paper anymore.
Yeah, exactly.
And Sarah, you're a first-time tax filer.
Yeah, so I, on the other hand, am very nervous about this. I don't really know what I'm doing, but I'm hoping we can figure it out together.
Awesome. Okay, so I just want to start off by saying there is so much here, and a lot of it is very complicated. We're going to do our best to explain stuff in a way that's interesting and useful, but I just want to say right off the top that a lot of these little deductions and subtractions and stuff like that we're going to talk about, they have some caveats and some like very specific things. So we're giving an overview. This is not tax advice. And if you do have more complicated tax returns, it's always a great idea to seek out a tax professional to get those questions answered. Virginia also has a great tax website, and we'll link a bunch of their pages in the show notes for this episode. Okay, so we have all assembled our laptops and our important documents, including, the one Sage's husband just sent from his greasy hands. But first, I think we need to talk a little bit about what a tax credit is and what a tax deduction is, because that's a big thing that we're going to go through on these state returns. So I want to apologize in advance for starting off with some kind of weedsy descriptions, but I think they're really important to build a foundation for the conversations we'll have in the rest of the episode. Okay, so we all earn income, right? And without any tax credits or deductions, we would all just pay our state and federal taxes on every dollar we earned. So let's say you earned $60,000. There was a flat income tax of 15%. You'd pay about $9,000 in taxes. But over time, the federal government and the state started using the tax code to incentivize and disincentivize various behaviors. And they do this in two ways, tax credits and tax deductions. And they both have very similar purposes, again, to incentivize and disincentivize behavior, but they work a little bit differently.
Okay, so what exactly are deductions?
So tax deductions lower the amount of income that you are taxed on. So here's an example. The government wants to incentivize Americans to save money for medical expenses. So they say if you put money in a health savings account, that money will not be part of your taxable income. So let's say you contribute $4,000 to a health savings account. And remember in my previous example, without any deductions, you'd pay $9,000 in taxes. Well, if you're only paying income tax on $60,000 minus $4,000, that would bring your tax bill from $9,000 down to $8,400. So that's basically how all tax deductions work. You have a certain amount of income that you make, and then the government says we will deduct amounts from that total in order to incentivize you to do certain things like save for medical expenses. And then, HSAs and a lot of these other deductions, they have caps. So you couldn't just put all of your money in a health savings account and not pay any taxes. There's about a $4,000 cap for individuals.
So there's also a standard deduction as well on top of these. Am I right?
Yes, yeah. So to explain this, we need to do a little bit of history. The first income tax in 1913 was only on high-income earners. And then in World War II, it expanded to most people who earn income in the United States. And by this point in the 40s, the tax code was already pretty complicated. There were itemized deductions for medical expenses and investment expenses and other things like that. And it's just a lot of bureaucratic work for the IRS. And it also meant that well-educated people who are higher income earners could get advice from lawyers and accountants, and they would end up paying less taxes, while, lower class people didn't have those resources. So they said, you know what? We'll just give everyone the option to take the same deduction, and hopefully people will take it, and it will really simplify things for the IRS. So today we have a ton of federal tax deductions, but if those deductions don't add up to $14,000, you don't have to bother itemizing your charitable donations or your medical expenses. You can just take the $14,000 standard deduction. So, the reason that they decided to introduce the standard deduction was to try and level that deduction playing field a little bit. But, these days, higher educated and higher income people definitely still use the tax code to have a lower tax burden than people that don't have access to those resources.
So are most Americans taking that standard deduction, or are they doing the itemizing?
Yes, 90% of Americans take the standard deduction, about 90%.
So why would somebody not want to take that standard deduction?
I would say the most common reason why people would have more than $14,000 for an individual in itemized deductions is if they're using the mortgage interest deduction. So at both the federal and the state level, you can deduct your mortgage interest from your income if you buy a house. I mean, a lot of people don't pay that much in interest every year, but that's a common one. And then for higher income or higher wealth people, charitable donations are a common one. If you donate more than $14,000 for an individual to charity, you might itemize instead of taking the standard deduction.
So what about credits?
Yes. So tax deductions, which we've just been talking about, those help determine what your tax bill is. So they lower the amount of income that you are taxed on. Tax credits are like coupons on your tax bill once you receive it. So a big common tax credit that people might encounter is the earned income tax credit. There are also tax credits for higher education, and you can get tax credits even if you take the standard deduction. So just very overview, deductions lower the amount of income you can be taxed on, and then credits are kind of tacked on at the end to lower your bill and incentivize other smaller behaviors typically.
Yeah, I think a common one I see is did you refit your house to be energy efficient this year? That's a big question.
That's a great example. Yeah. Okay, so have you all done your federal return yet? Because this is a state news podcast. We want to talk about state taxes.
Yes. I personally have put in all of my little income informations, and it's looking pretty good.
I have not. I've been so excited to do it together that I've held off until this moment right now.
Yeah, I got mine done a few days ago.
Awesome.
So what programs exactly are you guys using to do yours?
I'm personally using two different programs. So the IRS currently offers a free file program offered through 1040.com. So I like using that because Virginia is one of the states that you can file your state taxes in for free. But for years, I used Free Tax USA, which is a mostly free program. Their federal filing is always free, but there's a nominal fee attached to it. So I like to check them against each other because they function slightly differently with how many questions they ask you and how transparent the whole return is. I find Free Tax USA to be more transparent. So if you're interested in specific form names and stuff like that, it's really easy to see through. But 1040 is extremely user-friendly, and it doesn't ask you unnecessary questions.
Yeah, I also use Free Tax USA, and I just cough up the $15 for my state return. But I totally agree. It's super easy to use.
For a while, I compared Free Tax and TurboTax, and they were identical, really, and very similar user interfaces. So for me, it just made the most sense to go. I think usually Free Tax ends up being slightly cheaper, but
Your strategy of using the free federal e-filing software, but then checking it against free tax is so smart because you don't have to pay to use the software. You just have to pay to have them file your state return. So you can just check that the numbers are right and then file it for free with Virginia.
Okay, so we're finally switching from our federal to our state return. And the first question we are asked is about Virginia being our state of residence by the end of last year.
And a really interesting thing about this is like, did you live in this state on this specific day? It says, did you live in Virginia on December 31st, 2024? It doesn't say, did you live in Virginia the whole year? It just said, did you live this day? And a lot of these softwares, they're kind of like decision trees. So they're trying to make it as easy for you as possible. So we click yes on that one.
Now it's going to ask if you lived in Virginia all year.
Yes. So I did live in Virginia all year. It's very common for people to, work in other states for a few months. A common question here is college students. What if you're an out-of-state college student? You maintain a primary residence in Virginia, but maybe you go to college out of state. This is something that comes up commonly for people who are in the military. And in both of those cases, they recommend if you're a college student who maintains their primary residence at their parents' house in Virginia, then you should click yes for that. Another question to consider at this point is, do you have to file in Virginia at all? And you do not legally have to file if your income is below about $12,000 if you're single or about $24,000 if you're married. One thing to think about, though, is even if you made under those amounts, did you have any taxes withheld? So let's say you just graduated from high school and you go fill out all the paperwork at your new job. They're going to ask you a ton of questions. And I'll tell you that when I was 18 and I started a new job, I sure as hell didn't know what any of those questions meant. So I'm just sitting in the lobby, Googling things, trying my best to fill it out as quickly as I can. And it's very easy to check the box to set up withholding. So every time you get a pay slip, you're seeing those Virginia taxes come out of your paycheck, but maybe you only worked June to December. So you get to the end of the year and your total income was $11,000. You don't legally have to file taxes, but you've probably paid quite a bit of money to the state already. So you would want to file taxes in order to get that money that you paid that you didn't have to pay back. And you might also be eligible for a refundable tax credit.
What's a refundable tax credit?
So refundable tax credits are tax credits that exceed the amount that you owe. So most tax credits are like coupons, but refundable tax credits are kind of more like a gift card. So if you owe $1,000 in taxes and you qualify for a $2,000 regular tax credit, it'll only wipe out the $1,000 you paid in taxes. But if you owe $1,000 in taxes and you qualify for a $2,000 refundable credit, it'll wipe out the $1,000 you owe, and then you'll also get an additional $1,000 in your refund. So the Earned Income Tax Credit in 2022 became a refundable tax credit in Virginia because it's a way to give a little bit of extra money to working people in Virginia who are low income, especially if they have children. The Earned Income Tax Credit is designed to help people who have kids and are low income.
Okay, so this is where we start getting a little more specific on the next page. Which Virginia county or city did you live in during 2024?
This one seems straightforward, but for somebody like me, it's actually a little bit tricky. I'm a college student here in Charlottesville, so I live and work in Charlottesville pretty often, but I also live back at home with my parents in Spotsylvania. So which address or city should I be putting on my tax returns?
You could put either of them. It's really up to you. A lot of college students maintain a primary residence at their parents' home because, college students move every year. Sometimes you're only in a place for 9 months during the school year. Probably going back home, your parents are saving mail for you. So I would say typically you want to put your primary residence.
Yeah, sometimes they're saving my 1099s for me for episodes like this and sending me text pictures of it.
Yeah, that's very handy.
And right after that, we just get some similar kind of bookkeeping questions about if our address has changed or if our filing status has changed.
Yep, again, like you said, pretty straightforward. Just want to keep your info up to date.
So after that, we get to the point where they ask you about any Virginia subtractions from your income that you may have.
Yes, so this is pretty weedsy because subtractions are basically deductions, but Virginia has both things they call subtractions and things they call deductions, and they are both in a category that's referred to as above the line. So there are types of deductions that you can take in addition to the standard deduction, and then there are types of deductions you can only take if you itemize your taxes. So Virginia has both subtractions and deductions that are considered above the line. And the subtractions, reduce what's called your Virginia taxable income. So for most of us, our Virginia taxable income is going to be very similar to our federal adjusted gross income, but there's this list of other subtractions that Virginia recognizes. And some of these are really interesting.
Yeah, so I'm seeing things about historic rehabilitation as well as income earned as a Holocaust survivor. A lot of these seem like things that if you qualified for them, you'd probably already know that there was some tax-related connection to the thing you're involved in.
Yeah, they're pretty specific ones. They're kind of fun to click through. Every year, the Virginia Department of Taxation puts out a legislative summary. So they look at all the bills that were passed by the General Assembly that involve taxation, and they kind of describe them. And both with the subtractions and deductions, new ones don't get added or changed very often. So some of these have been around for quite a while. And a lot of them are fairly small amounts that you can subtract from your income.
So how did all of these little qualifications get turned into tax law?
Yep, they go through the General Assembly. A member of the General Assembly proposes a subtraction and gets voted on. It gets signed by the governor. A good example of this is subtraction number 28. So this is the Virginia National Guard income subtraction. And in 2023, there were some changes to this subtraction. It used to be, before 2023, that you could only subtract Virginia National Guard income up to $3,000. But then in 2023, there was a bill that upped it to $5,500. And the reasoning, they said, was to make it, more competitive with National Guard subtractions or deductions in other states. And one thing that's really interesting about this is that for potential legislation, so bills in the General Assembly that have to do with taxation, even before they're passed, the Virginia Department of Taxation creates what's called a fiscal impact statement. So they'll look at a bill and they'll say, this is the revenue impact if this gets passed. So for this Virginia National Guard income subtraction, they looked at the House bill, which proposed upping it to $5,000, and the Virginia Department of Taxation said that it would cost Virginia about $450,000 a year to change this cap from $3,000 to $5,000. So I only bring that up because I think it's such an interesting example of the scope of some of these subtractions, they apply to narrow groups of people. They're often on not huge amounts of income, and they have pretty small revenue impact. $450,000 a year in the grand scheme of the whole Virginia budget is really not a ton of money. And, my tax software reminds me that taking any kind of subtraction in Virginia is pretty rare. Most tax filers, these don't apply to them.
So going on to the next page, it's asking us if we have any Virginia deductions.
Yeah, so we just talked about subtractions, and then these Virginia deductions, they're also above the line, so you can take them and you can take the standard deduction. Very similarly, mostly on small amounts of money, don't apply to a ton of people. One thing that is good to note at this point is that if you itemized your federal taxes, so let's say you paid more than $14,000 a year in mortgage interest, you itemize your federal taxes, you have to itemize your Virginia taxes. And if you took the standard deduction on your federal taxes, you have to take the standard deduction on your state taxes. So if you're using a tax preparation software like TurboTax or FreeTax USA, they're only going to ask you these questions on the above-the-line deductions. There are, other below-the-line deductions that you wouldn't answer if you've already taken the standard deduction on your federal taxes. So some of these are pretty interesting. I got kind of curious about it, and there have been very few changes to these in the past 10 years, just looking at those legislative summaries. One that I was able to find, the bone marrow screening fee deduction, was introduced back in 1997. So a lot of these have been around for a while. And I think one of the reasons why they haven't changed a whole lot is that in 2022, Virginia almost doubled the standard deduction. So I think there's just been a little bit less interest in some of these more like niche deductions and subtractions, but they've made big changes to like the earned income tax credit, making it refundable, big changes to the Virginia standard deduction, taking it from about $4,000 for an individual to like over $8,000 now.
Speaking of the earned income tax credit, now we're on to tax credits that are specific to Virginia.
Yes. So again, deductions reduce your taxable income. Credits are kind of like coupons. Most of these are not refundable, which means they can wipe out your tax liability, but they're not like extra money in your tax refund. And just like the deductions and subtractions, these are passed by the General Assembly. And these amounts, though, they vary a lot. Like we were talking with the subtractions and deductions about how a lot of them are not crazy high amounts of money. But if you look at like the historic rehabilitation tax credit, you can claim up to $5 million in costs on that tax credit. So again, if like you're only paying a few $1,000s in Virginia tax because you don't have crazy high income, then even if you claim $5 million in historic preservation spending, you're only going to save $2,000 or $3,000 or whatever you've paid in Virginia taxes. But if you're a super high income earner and you spend $5 million on historic preservation, you could be wiping out a pretty substantial amount, if not all, of your Virginia tax bill. And that the Virginia Historic Rehabilitation Tax Credit has been around for a few decades in, some form. But some of these amounts get changed like with inflation and things like that. So that's a tax credit with a pretty high cap. But if you look at the firearm safety device tax credit, it's capped at only $300. So Virginia wants to incentivize people to keep their firearms in gun safes or buy gun locks, those kinds of things. So if you spend $600 on gun safety, you can only get $300 in tax credit.
Yeah, I always feel like when I'm looking at this, I'm like, wow, there's so much I could be doing if I had money. So to me, I maybe this is a very millennial thing, but it's just like, I just don't even have like property or any sort of capital to be accounting with in creative ways.
It does make your taxes a little easier to do, though.
Totally.
There's your trade-off.
Absolutely. That is a big trade-off.
Okay, so the next question here is about taxes paid to other states. It wants to know if we've paid taxes to any other states. As a general rule, you don't have to pay state income tax doubly in multiple jurisdictions, right? So a common question that people might ask is, what if I live in Fairfax, Virginia, but I work in D.C.? Or I live in Pocahontas County, West Virginia, but I work in Bath County, Virginia. So Virginia has reciprocity with those states / like D.C. is a jurisdiction, not a state. We also have reciprocity with Kentucky, Maryland, and Pennsylvania. So that means if you live in Virginia and you work in D.C. or you work in West Virginia, typically your D.C.-based employer will withhold Virginia taxes for you. So you only pay Virginia taxes, you don't pay them to D.C., you pay them through your employer. It's super easy. But Virginia doesn't have reciprocity with every state. We don't have reciprocity with New York. We don't have reciprocity with North Carolina or Tennessee. So If you live in Danville, but you work in Greensboro, then you don't pay double taxes, but you do have to file both returns. And basically, you just kind of go through some questions and they find out how much tax you've paid to the other state. And you don't have to pay double taxes. If there's a difference in the tax burden between the two states, you'll sometimes have to pay the difference. Sage, you've paid taxes across state lines.
Yeah, it was a few years ago at this point, and most of the time it was between West Virginia and Virginia, but I had switched residency during that time. So that changed it a little bit. You know, they wanted to know the percentage of my income that was made in a state while I was living in one of the states, you know. So it was easy to figure out, but I had 2 state returns that year. And then from there on out, it was pretty easy. Same thing when I moved from California to Virginia. I had to do 2 separate state returns.
Do you have any tips? Like, what resources did you use to figure that out?
I actually think the software is a really good guide. It asks you, you know, just answer it to the best of your ability and double check it after the fact, you know. I don't think I had to Google all too much during that time, but basically my barometer is like when I sign up for a job and fill out all of my tax information, I always choose the highest amount of withholding because I hate the idea of paying taxes in one lump sum amount one time a year. So I'm typically expecting a refund at this time of year. So if my numbers go from in the green, which means I have a refund, to suddenly very high in the red, I know something is probably wrong because I know I'm paying a lot of taxes as I'm getting my paychecks.
Yeah, super interesting. And I'm so glad you brought up the withholding question, right? Because one of the next questions that we get asked is Virginia miscellaneous topics. The one that I wanted to point out here was all the questions about estimated payments. You know, what are estimated payments? So we all, as employees of WTJU, which is owned by UVA, we all work for UVA. So UVA withholds our taxes for us. We're W-2, employees of UVA. But let's say you have some freelance income, right? So you're not paying business taxes, but you have some non-employee compensation. There are no taxes withheld on that. So for us, we can go into UVA and say withhold a little bit of extra tax, and that'll cover your non-employee compensation money. But if you don't have access to withholding, then you might need to make estimated payments on your freelance income, your non-employee compensation income. And then, there are a lot of different schools of thought on how exactly you should try to set up your withholding. You were saying you like to have a big refund. A lot of people like to get a big refund. They think of it as kind of like a forced savings account. And then, a lot of people will say, if you look at the returns you'd get on a high yield savings account or that you might get in the stock market, 4%, 8%, whatever, if the state's hanging on to that or the federal government's hanging on to that for you all year until you get your tax refund, you might be missing out on, your $40 of interest income on that $1,000 in your tax refund. So just something to think about. But I think, the best case scenario is to not owe any taxes. So it's good to make sure you're at least setting up your withholding to cover your tax burden for the year. And I'll also shout out, there are a lot of nonprofits that help people with tax preparation questions. I know there are some here in the Charlottesville-Albemarle area. So if you're starting to do this and you have some more complicated taxes and you're getting a little bit lost in it, but you don't have money to pay a professional, I would definitely look into one of those tax prep nonprofits.
Okay, so near the end, we come across a page that talks about Virginia use tax. What is that all about?
Yeah, so if you bought something in 2024 that you use in Virginia and you didn't pay sales tax on it, you need to pay Virginia use tax on your purchase. This was a big issue, in the early days of e-commerce, right? Because a lot of these big e-commerce sites had not worked out agreements with states and were not charging sales tax. It was a big problem. But the good news is these days, stuff we buy online is charged sales tax according to the state that it's shipped to. So if you're buying something like on Amazon and you're mailing it to, your relatives in other states, Amazon will look at what state they live in and charge you the sales tax for where it's being shipped. So I would say generally this is not one most of us have to worry about. If you buy something large and expensive and you didn't pay sales tax in another state, this might be something you need to worry about.
Yeah, like if you go to New Hampshire to buy a car or something
Exactly.
like that.
I think that's the case that this was probably designed for. Like you buy something pretty expensive in a state that doesn't have sales tax, they want you to pay Virginia use tax on it. Okay, y'all. I can't believe we made it through that.
I'm still unsure.
We haven't filed yet, I guess.
Yeah.
Who has the biggest refund?
I'm assuming I have the lowest. So mine is 144 for state taxes.
That's your refund?
Yeah.
Not bad. That'll buy you a couple nice dinners or maybe a couple textbooks.
William and I together have 174 state refund.
Okay.
So, yeah.
Pretty. Do you know what you're going to spend yours on?
No, William wants an amp, a new guitar amp.
Oh,
so maybe that. Maybe we'll do that.
I like it.
Yeah.
I have freelance income, so I will probably owe state tax when I do finally file, sadly.
All right. I have the biggest tax refund. Whoop, whoop. $233 is my Virginia refund.
That's great.
Yeah.
Did you have any credits?
No, I didn't have any credits. I just withheld a little bit for the year.
Oh.
So I win or lose, depending on your perspective, the biggest refund award. What other questions do we have about taxes?
What's the deal with auditing? Should I be worried that the IRS is going to be coming after me soon?
Yeah, great question. So Virginia audits businesses as well as individuals. They don't publish their selection methods, so I can't tell you whether or not you'll be audited. But some common themes that tax lawyers in Virginia have noticed is that people tend to get audited if they have past taxes owed, if they make mistakes on their tax return. Cash-based businesses are very likely to get audited. And then if you miss or file your taxes late, and owe fees and penalties, those are the types of things that apparently tend to be common among folks that Virginia chooses to audit. If you do get audited, you'll get a letter with a deadline to respond, and you just send them whatever information they ask for. The other thing to be aware of is that the Virginia Department of Taxation also charges penalties and late fees. So even outside of auditing, they're paying attention to whether or not you're paying your taxes in full on time every year. And so even if you don't get audited, if you're not paying your taxes on time or you're not paying them in full, you can get charged penalties and fees that are between 2 and 6% of the tax due. And then they also charge interest on late payments. So it's definitely in your best interest if you're able to pay your taxes on time. They do sometimes forgive penalties in cases like if the taxpayer has died, if you're trying to settle an estate or something. They also mentioned on their website that sometimes they'll forgive penalties in case of natural disaster. So maybe your records were destroyed and you need a little extra time to put your taxes together. And then, in cases of fraud, they have civil and criminal penalties as well. So overall, pay your taxes on time, pay careful attention when you set up your withholding. And if you have a more complicated tax situation, consider consulting a tax expert because you don't want to start accruing interest or penalties or fees. And again, like we talked about last week, our state taxes primarily go to pretty important things like schools and health insurance for low-income people. So it can be annoying to pay taxes, but it is the price that we pay to live in a society.
How does Virginia compare to other states?
Yeah, so Virginia collects the 19th highest amount of taxes per individual. So on average, Virginia collects $4,226 in taxes per person. The highest one is California. They collect $7,000-ish per person on average. And the lowest is New Hampshire, which is about $2,500. In general, southern states like Florida, Texas, South Carolina, Georgia, they tend to be, on the lower end of the list. And then the Northeast tends to be higher. Vermont, Connecticut, Massachusetts, Delaware, New York, New Jersey. I think this is kind of like something we all think about, like sort of common sense. Although if you do look at the full list, there are some interesting states that like kind of buck the trend and are unexpected. Like, New Hampshire is right up there in the Northeast, and it's the lowest tax per person in the country. And then I also am fascinated by North Dakota and South Dakota because, they're right there next to each other. I think a lot of us, East Coast assholes tend to kind of group them together. But South Dakota collects the third lowest amount of taxes per person in the country. And North Dakota is the second highest per capita. So North Dakota is right up there with California. South Dakota is right down there with New Hampshire. Pretty interesting.
Yeah.
All right. Any other questions?
I think taxes are pretty great. Especially when you talk about them with friends.
Well, you're getting that $500 refund,
Yeah, I guess that's what makes it easy.
Yeah, it is nice to get the little,
A little bump.
a little bump.
Okay, I think I'm filing right now.
Oh, this is a big moment.
They're telling me to double check my return, and I'm like, I've double checked it. My return was free.
Woo!
Okay, now I've got to put in banking info, but yeah.
Yay! Sarah, how are you doing?
I'm doing great. I'm so happy I had people to help me out through this. I don't know. I would be a lot more stressed doing this by myself.
Good. Yeah. Nothing like taxes with a friend. All right. Well, thank you all so much for joining me and hanging out on this long trek through our tax returns.
Thanks for having us. It was a lot of fun.
Great. This has been Sage Tangway, Ben Larson, and Sarah Bastinelli, and I'm Mary Garner McGee. You can find more Bold Dominion episodes at bolddominion.org or your favorite podcast app. Thanks for listening.